Hi, this is Stephen here from Share Navigator with our options and futures update. Our existing SPY trade, just follow the video from yesterday. We've nothing to do there today. It's going perfectly well for us. That's going to expire worthless, and we're going to make a small profit in that trade. I want to focus all the energy in now on a potential trade on crude oil, and I'm going to show you different ways of trading it for people who have different levels of risk. So if you can look at the chart here, crude oil, you can see it's been trading sideways here for pretty much over a month. I will highlight the risk, and the next level of support down here, if this support doesn't hold, potentially is about a 10% drop. Um, Having said that, it's been trading in this 10% range, and we're now on the lower Bollinger Band, and we're looking to trade it up to the 20-day moving average, which is about 5% higher. So I'm just going to go through the different ways you could actually trade this, if you did decide to participate. First of all, the simplest way is through USO. So USO is an ETF that tracks the crude oil futures, basically. So that you can buy and sell that like a stock. The only thing is, for European-based investors, the only way you can get access to that is by selling in the money put options to get control of it. It's just a regulatory thing that's preventing European retail investors from buying it. If you're in a pension fund, you can buy it. That's different. It's just for retail investors. So that's the simplest way, and probably arguably one of the lower risk ways. The other way is by going into the futures outright. So I'm just going to show you here. And there's two futures you can do. You can do the standard futures contract, or you could do the main futures contract. And the only difference between the two of them is actually the size of the contract. So CL is the main contract, and that's quite a big one. I would be going for the December one. It will always default in your trading platform to the front month. Let's go to the December one, give ourselves some time, and the class is CL. So you can see the multiplier here is 6,000 or is 1,000. So in other words, the value of our exposure, if we bought one contract of this future, would be 61 times 1,000, which is 61,000. So if people fancy that trade, that's one you could do. You could buy one futures contract. Remember, we're only looking to trade this up 4%, but if this support doesn't hold, we think this could go down another 10%, which means that you'd be losing $6,000 on that trade if it didn't go your way. Now, what I would do in this, depending on the size of your account, is just dollar cost average in. I'm going to show you a lower risk way of getting access to this in a few moments, and it's well worth watching that. The other one, which is the micro version, is just simply it's basically a tenth of the value of that. So you can see the multiplier in this situation is only 100. So you can see 1 point is $100. So your contract exposure for MCL on the futures is 6,100. So in this situation, if it fell 10%, you would only lose 6,100. You don't gain as much going up. So futures are slightly different options. Options give you a right to buy something. When you enter into futures contracts, you're basically obligating yourself to buy. Now, that's if you go right to the full term. What we do is close out before we get to that position, and we'll make a profit or a loss. So a simple way is just buying the futures contract, whether you go the main contract or the micro contract. I'm going to show you now, this is what I'm really excited about as well. You can also use options here to go and trade these contracts. So let me show you here. So if we typed in crude oil here, and we looked at the options on crude oil, I just want to explain the expiries first of all. So the first part of the expiry dates here, that's the option expiry date, and the second part is when the future expires. So this, for example, is the option expires on October the 8th, but it's for the November futures contract. Now, we're interested in the December one, and we want to go out about a month or so. So we're going to go, let's say, to the October 29th option expiry for the December futures contract. So let's say, for argument's sake here, you're looking at crude oil and you're saying, you know what, I don't fancy this, just in case it falls. You can come down here and sell an insurance policy down here at the 55 strike on the futures. So in other words, you wouldn't go and buy your futures contract until the crude oil dropped to 55. And while you're waiting around for providing that insurance, you're getting paid an insurance premium. So let's see what that insurance premium is for the main contract. We'll go down to the 55 strike here. And we can see here we're taking in 47 cents now. It's 1,000 multiplier, so it's actually 470 we'll be taking in. So you can see here, our max return here is 440. It's saying our max loss is 54,000. That's as if, basically, that's the situation where crude oil goes to zero, which is very unlikely. It has happened before, but it's very unlikely between now and the end of October. And you can see our probability of profit here is 90%. And the reason the probability is higher is, if you think about it, we will profit now if crude oil goes up, if it goes sideways, and if it just doesn't fall any more than 10%. So we're making profit in three different ways. Whereas if we bought the crude oil contract futures now, it would have to go up in order to make money. That's why we have so many more outs on this. So you could use a put option, sell a put option on the crude oil contract at the 55 strike. And you also have them available to you in the micro futures. The only thing I will say to you is the expiries are different. There's not as many expiries on the micro futures. So for people who have a smaller account, you could do that. And then finally, if you wanted to reduce your risk even further, so let's say you were saying, God, what happens then if crude oil falls to 40, for example, in the next 3 weeks? Well, if you're that nervous about it, you can turn this into a bull put spread. So you would buy a put option for the same expiry underneath. So what you're doing here is you're reducing the amount of premium you're taking in. So in this case, we could only make $300, but we know exactly what we could lose on this main contract. So we couldn't lose a massive amount of money. We'd lose 4,500. But again, our probability is 89% on that. So if you wanted to reduce your risk on that, you could by buying a put option underneath. So that's just a number of different ways. Just very quickly, in summary, the simplest way is just buy USO, wait for it to go up. If crude oil falls, you could average in again. You can do it the same way on buying the futures contracts, whether you do the main contract or the smaller contract. And then finally, you could sell put options, which is probably the least risky way of the whole lot of them, because ultimately you're giving yourself an opportunity for crude oil to fall further. Okay, this is Stephen with an update on our futures and options trades. Hopefully you've learned something there on different ways to trade crude oil futures. Thanks and bye for now.